What if I told you there's a company that has grown its revenue by over 769% this year, turned a massive loss into a $155 million profit, and just signed one of the largest AI infrastructure deals in history? This isn't a hypothetical. This is Nebius Group, ticker NBIS, and it's rapidly emerging from the shadows to become a direct competitor to giants like CoreWeave in the high-stakes race to power the AI revolution. Welcome back to the channel. In today's video, we're doing a deep dive into Nebius Group to answer the critical questions. What's driving this explosive growth? Is it sustainable? And should this stock be on your radar? First, what do they do? In simple terms, Nebius Group is an AI-focused cloud platform. While Amazon AWS and Microsoft Azure serve everyone, Nebius specializes in one thing: providing massive computing power, specifically GPUs, for training and running massive AI models. Think of them as the ultimate power plant for the AI economy. Their business model, dubbed NeoCloud, offers flexible GPU rentals and dedicated infrastructure contracts. They're not building the AI models themselves. They're selling the picks and shovels, the essential compute, to the gold miners. Founded by Arkady Volozh, the co-founder of Yandex, Nebius started by serving AI startups like HeyGen and PhotoRoom. But the real story is their recent pivot to major enterprise clients, which signals a huge leap in credibility and recurring revenue. Nebius isn't trying to be everything to everyone. It has carved out a critical niche as Europe's foremost AI-native cloud provider. In a world increasingly concerned with sovereign AI and data residency, Nebius's European regulatory alignment is a massive advantage.
But here's what's fascinating. They are both a competitor and a partner to the giants. They supply GPU clusters for Microsoft Azure's Copilot while simultaneously competing directly with services like AWS Bedrock and NVIDIA's own DGX Cloud. How do they stand out? First, AI-native infrastructure, built from the ground up for the latest NVIDIA platforms. Second, built-in compliance with EU AI Act and NIS2, a huge selling point for European enterprises. And third, they are already a top 5 global GPU leaser and Europe's top private AI cloud by GPU capacity. Now let's look at the numbers, because they are staggering. Revenue. They are projected to go from $118 million in 2024 to over $556 million in 2025. That's a nearly 5x increase. Profitability. They've swung from a loss of $641 million last year to a net income of $155 million this year. This is a monumental turnaround. Stock performance. The market has taken notice, with the stock surging over 300% year-to-date. And perhaps most impressively, they maintain a super conservative debt ratio of just 26%, giving them huge financial flexibility for expansion. This isn't growth at all costs. This is disciplined, high-margin hypergrowth. Their secret? Record GPU utilization rates approaching 90%. In simple terms, their expensive hardware is almost always running at full capacity, which is incredibly efficient and profitable.
This explosive growth isn't just hype. It's being driven by concrete, massive catalysts. Catalyst number 1, and it's a bombshell: the Microsoft partnership. In September 2025, Microsoft signed a multi-year deal with Nebius, reportedly worth up to $19.4 billion. Let me repeat that: $19.4 billion. This deal involves over 100,000 NVIDIA GPUs to help Microsoft train its AI workloads like Copilot and Azure OpenAI. This instantly positions Nebius as one of Microsoft's largest infrastructure suppliers and validates their entire business model on a global stage. To fund the expansion for this deal, Nebius raised $1 billion, showing they have the capital to execute. Catalyst number 2 is their expanding client base. They're no longer just a startup darling. They're now working with Cloudflare, Prosus, and even Shopify, which is using them for its generative commerce initiatives. This diversification into enterprise-grade contracts de-risks their business models significantly. So how are they fueling this growth? With massive global infrastructure expansion. They're building out data centers in key locations, like a new 300-megawatt site in New Jersey and across Finland, the UK, and Iceland, aiming for over 1 gigawatt of total capacity by 2026. But hardware is only half the story. In late 2025, Nebius launched its AI Cloud 3.0 Aether platform. This is their masterstroke, evolving from a compute vendor to a full-stack enterprise AI platform. Aether is a game changer because it delivers supercomputer performance that leads industry benchmarks, enterprise-grade security and compliance with certifications like SOC 2 and HIPAA, making it a go-to for finance, government, and healthcare, and tools that have deployment time for AI models.
So what's the outlook? Analysts are bullish, forecasting sales to climb to $3.6 billion in 2026. The entire neo-cloud sector is expected to grow 45% plus annually, and Nebius is positioned as a key player. According to data from MarketBeat, the analyst consensus for Nebius is a buy. Out of 7 tracked analysts, 5 say buy, 2 say hold, and importantly, none are saying sell. That's a broadly bullish starting point. However, there's a catch. The average price target from this group is around $91, which is actually below the current share price. So what's going on here? Well, when we look at other platforms, the picture gets more nuanced and a bit more optimistic. Benzinga, for instance, reports a higher average price target of $105.50. This range includes a sky-high target of $130 from BWS Financial and a much more cautious $47 from Northland Capital. But here's the key takeaway. The most recent updates from major firms like Goldman Sachs, D.A. Davidson, and BWS Financial all place Nebius's fair value in the $120 to $125 range. That implies a potential 5 to 10% upside from current levels, suggesting that the most up-to-date analysis is still positive. However, and this is crucial, we must talk about the risks. Execution risk. Building and scaling data centers is incredibly capital-intensive and complex. Can they physically build out fast enough? Customer concentration. While diversifying, a $19 billion deal means they are now heavily reliant on Microsoft. Any slowdown there would have a massive impact. Supply constraints. They need to secure next-generation chips from NVIDIA and AMD, competing with every other tech giant. Dilution. The $1 billion raise was necessary, but it can dilute existing shareholders. So where does this leave us? Let's synthesize everything. The major consensus is a buy to strong buy. The average price target range is wide, from $90 to $125, and the implied 12-month performance is essentially flat to a modest 10% upside from here. Analysts are framing Nebius as what's known as a high-beta growth compounder. That's a fancy way of saying it's a volatile stock, but one with the potential for massive long-term growth due to its position in the AI infrastructure boom. The general view on Wall Street seems to be this. The long-term story is incredibly compelling, but the short-term volatility is high. Because of this, many analysts suggest that the best strategy might be to buy on any significant pullbacks and hold for multi-year exposure to the AI infrastructure theme. What do you think? Is Nebius a buy at these levels, or are you waiting for a pullback? Let me know in the comments below. Don't forget to like and subscribe for more deep dives. Thanks for watching.